Hi, in this video we're going to talk about the PVR Inox merger, and we'll try and decode the math behind the merger. What was the logic behind the merger, and does it hide some underlying issues with the industry more than what it tells us with the numbers that are available? So let's first go through the understanding of the merger. Last week PVR and Inox announced this merger where they said that for every 10 shares held for Inox you'll get 3 shares of PVR. The combined entity would have close to 50% of the share in terms of the multiplex screens in India, and would have approximately about 15% share in terms of overall screen base of the cinema industry in India. Ajay Bijli would be the MD of the combined entity, and the industry itself, the combined value of the two companies put together would be close to about 20,000 crore in terms of the market cap. Right? We'll look at individual numbers as we go along and what was the rationale behind this. If you look at the entities individually, on the top you see PVR's data, which will reflect that the number of screens has grown from something like 464 all the way up to 840 in the last year. In this, of course, FY21 is a bit odd because of the pandemic, and all the numbers have gotten distorted. So for any analysis that we have to do, it would be a better idea to look at numbers till FY20. If you look at the numbers from the revenue perspective, the revenue in crores was about 1500 odd crore, which went to about 3,500 crore by FY20 for PVR. The numbers for Inox were slightly lower in terms of both the number of screens and all. Number of screens for Inox were about 300 odd in FY15, went up all the way up to 650, close to that at the time of the merger. And the revenue was about 2,000 crore in FY20 before kind of dropping off in FY21. If you combine the two entities, you will find they have close to about 1,500 odd screens and close to about 5,000 crore, slightly more than 5,000 crore worth of revenue. That happened in financial year 2020. The footfalls in terms of the number of customers walking in was about 16 crore or 168 million that you're looking at. So as a combined entity, this is a huge entity. In their best year in these years, their operating profit margin was close to 20%, and their net profit margin, while it has varied a little bit, would be close to about 6 to 7% in their best year. Right? So that's the construct of the merger. Obviously, why does the merger make sense? What's the rationale? Right? So better synergies. Of course, if you have two large players merging together, a lot of your cost structure, your understanding of the industry kind of, the synergies kind of come into play there. You have a very strong bargaining power with distributors. Remember, in India, when a movie gets released, the box office collections, a percentage of that is shared with the distributors. This percentage is higher for large movies for the distributors because distributors are strong. Now that these two entities have combined, now that PVR and Inox have combined, they have a little better bargaining power as against the distributors, purely because now they kind of control about 1/6 of India's screening capacity in the first place, right? So the idea would be to probably reduce the amount that you're paying to the distributor as a share of the movie revenue that's going to exist. The second idea would be to look at better utilization of the screen space. So far you had to kind of compete with Inox as PVR or PVR as Inox. So the context was to kind of ensure that whatever they are running, we also run as movie screen on our screens. What this does is it allows you to rationalize that a little bit. So you don't necessarily compete with them now. You can essentially use that inventory of screens much better in terms of showcasing movies that you would want to. So that's an advantage. The last bit would be a better bargaining power with respect to malls. Remember, real estate or the space that you choose for a movie screen is going to be paramount, because usually you find that these cinema halls are within malls. While malls also need cinema halls for success, usually malls without cinema halls are rarely a big success in India. But at the same time, if your top two players combine together, they again increase their bargaining power against the mall owners, right? So in terms of cost structure, there is substantial advantage that kind of comes out, both in terms of lower distribution revenue that kind of gets shared and better bargaining power with malls. In addition, there will be synergies in terms of better utilizing screen space and cost synergies across a lot of other avenues as well. So makes sense from the cost perspective. Does it make sense from the larger perspective of revenue as well? Does it mean that the industry would grow significantly and will be able to fight the other challenges that are coming across its way? That's what we need to kind of understand a little bit more. The news was taken unequivocally positive by most of the news outlets that came out, right? So almost everybody was saying that this is a big merger, this is going to change the face of the entertainment industry, how mega the merger will be, how good it would be. Let's now explore what are the possibilities that come out of it. right? Especially on the revenue side of things. So when we look at revenue, I've now taken data from FY15 to FY20 only, removing FY21. And we are trying to identify how much revenue does each of these companies make on a per screen basis or a per customer basis, right? So we take the revenue and we divide it by the number of screens. You'll get a revenue of close to about 4 crore per screen for PVR and about 3 crore per screen for Inox. Obviously, PVR is a bit more premium as compared to Inox in this context. Revenue per customer, if I just divide the revenue by the number of footfalls in millions, you'll get revenue per customer would be about 300 odd rupees for PVR and about 290 odd for Inox. The combined entity, of course, will have something in between in terms of the numbers. Now, the question we have to ask is how many screens can India have? Second, how much more can you make on a per screen basis, right? Now, there are various ways to look at it. Broadly, it's difficult to increase ticket prices beyond a point because there will be, some sort of a backlash in terms of higher ticket prices that are going to come in a world where options are available in form of OTT content as well, right? So we have to see that, but let's look at some global parallels. So the closest parallel you'll find is something like an AMC Entertainment in the US. And if you look at AMC's revenue numbers for 2019 calendar year, that's about $5.5 billion, right? If you convert it into rupees crore, it'll be approximately about slightly higher than 40,000 crore, at a conversion rate of 75. And if you divide by their number of screens, they have close to about 10,000 odd screens across the world. This consolidated data. So on a per screen basis, again 10,000 screens, 40,000 crore revenue, you will arrive at a similar-ish number of 4 crore, which PVR is already making. PVR is already making this 4 crore of revenue per screen. So given that that's the scene in US, it would be a bit odd to kind of understand how this revenue goes up significantly, how much more ticket prices can go up from where they are. So that kind of creates some sort of a boundary condition in terms of how much more can revenues increase on that account. The next pick you want to see is, let's assume that plays out, and the companies have kind of come out and said that they're going to add about 200 screens per year, which means that in about 5-6 years they'll have about 3,000 odd screens put together. If they reach 3,000 screens and we assume roughly about 4 to 4.5 crore per screen revenue on average, remember that number as an average will go down now because this is 4.1 and this is 3.1, so the average would work out to about 3.6 crore. Assuming that increases to something like 4.5 crore over this period, right? It goes to 4.5 crore over the next 5-6 years. You'll probably look at about, close to about 14,000 odd crore of revenue. Their net profit margin in the best of the years is about 6% to 7%. Maybe that increases a little bit here or there. But my sense is that with the advent of OTT coming in, there will be a little bit more, cost pressures coming on a variety of other kind of content creation regimes as well. So there could be a possibility that best case net profit margin stays in this range of 6 to 7-8%. If that is the case, you're looking at a profit number of somewhere close to about 1,000 crore here, right? 1,000 crore profit in FY27, FY28, somewhere around that period, depending on the number of screens the company has. These are expected numbers, remember, for FY27. That's what we're kind of putting in. The combined market cap of these two entities today is about 20,000 crore. Assuming that, at that point it trades at a certain PE multiple, maybe let's say 30, 35, the combined market cap would be close to about 30 to 35,000 crore at that point of time. 20,000 going to 30, 35,000 over a 5-year period is not a significant growth rate if you compare it to the market index in itself, right? The market index would be expected in India to kind of move at 12, 13, 14% CAGR over the next 5-6 years. If a company in a so-called sunshine industry is going to give you 12, 13% CAGR over that period, you might not be that excited with that kind of a return, right? So that's something, unless the number of screens go up dramatically. Now here we have assumed that the number of screens have kind of doubled. What's the scene with screen addition? We keep reading about this idea that, screen penetration is low in India. In fact, in 2010 annual report of PVR, they had mentioned that India had about 12 screens per million population as compared to 120 odd in the US, and so this should grow. The interesting part is they said the same in 2015, both of them in their annual reports. In 2018, Inox said the same in their annual report, and then as you go further, you'll say that PVR said the same in 2021 annual report for them as well. So despite this under penetration of screens in India, despite the fact that number of screens in India is low at 8 or 9 per million population, this number hasn't really grown. In fact, overall number of screens in India has actually gone down in the last 5 years. That wouldn't add up for an industry that is so underpenetrated, right? I mean, the share of multiplex screens could increase, but the share of single screens is going down, which does tell us a little bit of the underlying issue with the industry. This is an industry that practically grows only by growing your screen number. In fact, if you look at the revenue combined value of these two entities put together, their combined revenue CAGR, right, would be close to about 18%. But the screen CAGR, which is the speed or growth rate at which screens have been added, is also 12%. Right? So revenue is screen plus revenue per screen. So the revenue per screen has only grown at the differential, which is about 5-6%. That's not a very good growth rate, technically speaking. I mean, if you think about it, the reason they have been able to grow revenues at 18% is because screens have grown at 12%. If you remove the screen growth out, the revenue has grown at about 5-6%. If the screen growth stops at some point of time, and it will, at some stage you will reach a saturation point in terms of number of screens. At least in the last 10 years, we haven't seen too much screen addition in India. That's what comes across with all these annual reports. It seems to be an interesting question that we have to answer as to how many screens will they actually add? Will they actually even reach 3,000 screens at the end of this 5-6 year period? That's something that we have to look at. And so then, does it hide something more than what it tells us? Why would the top two players merge if the growth was going to be so strong? I mean, they could have grown easily individually as well. The very reason that the top two kind of decided to merge does tell us that maybe they're worried about what faces them as competition, which is this entire content revolution that's happening around us, which is this entire OTT apps content that is coming around us. And the companies probably realize that unless they get together, it's going to be a tough battle uphill from here, right? Think about it from the OTT players perspective as well. If you were a Netflix or an Amazon Prime or a Disney Hotstar at this point of time, what would you really feel when you see this news? Would you really get worried that the top two multiplex players are getting together? I don't think you even think that as a longer term strategy consideration for yourself. So if that competition from OTT is going to continue, if that is the way the content is going to get distributed in the future, unless this combined entity decides to diversify its revenue stream into some other areas like content generation or production, it is going to be an interesting thing to see in the future whether this actually tells us more positive news about the industry or it is hiding some negative underlying trends in the industry that are playing out. One interesting anecdote at this point of time is Netflix is actually set to spend about $17 billion for content next year. $17 billion is greater than the overall box office revenue that happens in the US, right? So if the content budget is much bigger than the box office revenue that's going to come out on a platform like Netflix, which can distribute it globally, then you do have to kind of see what's the threat that's coming towards the cinema exhibition industry in that context over the next few years. My sense is that this merger tells us a little bit more about the underlying strain that the cinema exhibition industry is facing because of the advent of OTT players, and that's likely to persist. This is inherently a segment that grows only by adding screens, or majorly by adding screens. So the day you stop adding screens, the revenue growth kind of starts suffering. You can't increase ticket prices significantly. You can't change occupancy rates significantly. You're dependent on somebody else's product or a movie to become a blockbuster for your fortune in that particular year. It's a tricky industry, and this merger for me doesn't really change anything specifically in the underlying trends of the industry. If at all, it hides some of the negative undertones that are playing out in the industry. I would be a bit cautious about this industry. Having said that, a standard disclaimer, please do not treat this video as a recommendation to buy or sell any securities. That's it from me in this particular video. Thank you.